Welcome to the 14th podcast on Tradable permits. Tradable permits are an alternative to emission limits or caps. And the main idea is that property rights are allocated over pollution, and then these rights are made tradable. We often refer to this scheme as cap and trade, because we cap emissions at a certain level and the permits are tradable across participants to this scheme. So we can create a market for pollution rights, and this market allows for the emergence of the market price. The main advantage is that if there are no firms with market power in the permit market, not the output market, the permit market, this price provides the correct incentives for polluters to choose emissions such that the cost minimizing solution is reached. That means that once you introduce an overall cap for all firms, then they will trade to finally reach the cost minimizing solution. And we will explain how that works in this podcast. So in this podcast, we will talk about the procedure of introducing permits, its advantages, the key factors for success of this instrument, and finally we will mention some experience that has occurred in several European countries and other countries. So what's the procedure of introducing such a scheme? First, the policymaker determines the maximum, possibly socially optimal, amount of emissions that is allowed, and that is what we call the cap. Second, the policymaker issues one permit or allowance for each unit of emission allowed. Third, the permit owner has the right to emit 1 unit of emission, and the duration of the right is a year or longer. Finally, the permits can be traded, in particular if the owner realizes that she does not need all of her allocated permits, she can sell some of them on the permit market. If on the contrary, her allocated permits are not sufficient to cover her emissions, then she can buy additional units. So imagine there are 2 firms on the market which have been allocated that many permits to pollute. This is represented by the circles. The firm on the left only emits this much, the gray cloud, which is less than what she is allowed to pollute. So this firm has some leftover allowances, which she can sell on the market. The firm on the right, though, is emitting more than what she is allowed to. So the solution is that the firm on the left gives her allowances to the firm on the right, which will give money in exchange for the permit she buys. In the end, the principle is simple. A polluter initially can't emit more than the quantity of permits she has been allocated. If she emits less, she can sell her excess permits, and if she emits more, she has to buy permits from other polluters. An obvious question which may come to your mind is how to allocate the permits to firms. There are different ways for the policymaker to distribute tradable permits. The permits can be sold to firms in an auction, or they can be grandfathered, which means that it is a free allocation based in proportion of firms' historical emissions or according to some other measure. And as soon as permits have been allocated to firms, they can be traded among firms on the permit market. Let's have a look at this more formally. Firm I maximizes profits given the policymaker's initial allocation of permits, EI0, and the price, PE, for 1 permit on the permit market. So profits consist of the revenue PQI minus the cost of producing and abating, CI of QI and AI, plus the price of permits, PE, times the difference between the initial allocation and what is actually emitted. So if the firm emits less than what she is allowed, the latter term is positive and it is equal to the amount of permits that can be sold. So it consists of an additional profit for the firm. If, however, the firm emits more than what she is allowed to, then this term is negative and it gives the amount of permits that have to be bought by the firm. So this consists this time of a cost. What are the first order conditions? With respect to QI, we have that P is equal to the marginal cost of production plus the price of a permit times the marginal emission from production. And with respect to AI, we get that minus the marginal cost of abatement is equal to the price of a permit times the decrease in emissions from an additional abated unit. So what's the interpretation of these conditions? The first condition says that the firm produces up to the level where the marginal benefit of production is equal to the marginal cost of production, plus the marginal cost of permit purchases due to an additional unit of output QI. The second condition states that the firm will abate up to the level where the marginal cost of abatement is equal to the marginal benefit of abatement, which is also the marginal benefit of selling or not having to buy permits on the market due to an additional unit of abatement. Let's compare the case of a permit market with the social optimum now. As usual, we have the conditions needed to reach the social optimum on the right and the conditions obtained with a permit market on the left. In the first line, which refers to the conditions related to production, and in the second line, which refers to the conditions related to abatement, we observe that the social optimum for both production and abatement can be reached if and only if the price of a permit is set equal to the marginal damage. So that's the rule. PE is equal to D prime of E. In other words, the total amount of permits must be set such that the market price equals the marginal damage of emissions. Why is trading beneficial? Of course, it depends on what you compare it with. So let's compare it with an emission standard or limit, for example. In this case, trading allows for more flexibility since profit-maximizing firms can reduce emissions to meet the number of permits received or bought. They can buy additional permits on the market to meet extra emissions incurred. Or they can reduce emissions below the number of permits they have received and sell unused permits. What is crucial here is that the targets will always be reached at the lowest total cost to society, regardless of the initial allocation of permits. Why? Because firms with low abatement costs will sell permits and abate instead, while firms with high abatement costs will buy permits and abate less. So firms with low abatement costs abate more and firms with higher abatement costs abate less. And that means that abatement is done where it is cheaper. It is cost efficient. What are the key factors for the success of this scheme? For the credibility of the trading system, permits have to have the same characteristics as property rights. And specifically, institutions have to be reliable, and the duration of permits needs to be specified or permanent. Some countries have already collected experience with permit markets. This system has been established in different countries and for different types of emissions. It also exists for renewable resources, such as fisheries to protect them from over-harvesting, and this kind of permit is called tradable quotas. In the US, the trade scheme for sulfur dioxide has been introduced to hedge from acid rain. In the European Union, a cap and trade on greenhouse gas emissions has been introduced, and this emission trading scheme, ETS, covers carbon dioxide, nitrous oxide, and perfluorocarbons. Here is actually a map of the global effort to introduce carbon markets, which are markets for greenhouse gas emissions stemming from fossil fuels. The countries in green have already introduced some cap-and-trade schemes, and those in yellow are considering to introduce them. So clearly, you can see that the European Union played a major role, but also Kazakhstan, for example, some cities in China, in Japan, the Republic of Korea, in the US as well, and Canada, these cities have introduced as well a carbon market. And hopefully this process will continue, and someday we may have a global carbon market, which involves all countries. To sum up, we have seen that tradable permits can, if the number of allowances is set appropriately, successfully internalize environmental externalities. That means it achieves Pareto efficient levels of both production and abatement, as a tax does. Even if the cap is set too high, such that total emissions are inefficiently high, trading will still lead to cost efficiency. Because always, the firm with high abatement cost will abate less, and the firm with low abatement cost will abate more. This is cost efficiency. And some countries have already gained experience in designing and implementing cap-and-trade scheme.